Hey guys, it's Mrs. Invest. I missed you. I hope you guys had a great summer. I just got finished with a summer of crazy travel and adventure, and I just couldn't sit down and make a video on investing, although I did think about making like videos and putting them up on the channel of some of my international adventures, but I wasn't sure if that's something that you guys would want to see. Let me know if that's something that interests you. I know it's not really like directly related to investing, but at the same time, it's like the whole point of investing, right, is to have a portfolio so that you can spend time in your life doing the things that really matter to you and make you happy. And for me, that is going around the world, seeing different places, seeing different geography, seeing different cultures. So let me know if that's something that you'd want to see. But for today, I do have an investing topic video for you, and I'm going to be talking about asset allocation ETFs. So if you've watched some of my other videos on this channel, you know that we've talked a lot about stocks where you buy shares of an individual company. And then I've also spent a lot of my videos on talking about ETFs, which are where you buy an ETF that in itself holds many different stocks. And then in order to create a portfolio for yourself, you may have to have a few different ETFs. So for example, where the S&P 500 ETF is an awesome ETF, it has performed really well, and I think it will continue to perform well in the future. If you just owned an S&P 500 ETF, let's say like VFV, you couldn't really say that you had a complete portfolio because you're really just owning the 500 top companies in the US. So you're kind of heavily concentrated on just that and not owning anything else. And so where the asset allocation ETFs come in is they are an ETF that within them hold different ETFs such that you have a complete portfolio. So it's kind of the one and done type thing. So people who are, if you're watching and you're a beginner, or if you're watching and you're really lazy and you want to keep things as simple as possible, but you also want to have better returns than you're going to get by just having your money in a savings account, then this is something that might really interest you. And this is also the type of portfolio that you may sometimes pay a robo-advisor to make for you, or pay a financial advisor or an investment advisor, wealth management, whatever you want to call those people, huge percentages of your total portfolio value every year to make specifically for you. And oftentimes these portfolios are literally mirror images of these asset allocation ETFs. They just pick one that has a allocation that is going to be best for you and your life stage and what your goals are. So today I'm going to talk about 4 different asset allocation ETFs: XGRO, VGRO, XEQT, and VEQT, which are the most popular of the high equity asset allocation ETFs by Vanguard and by BlackRock Ishares. And I'm going to break down what they're all about. And at the end of the video, we'll talk about the difference between VGRO and VEQT and XGRO and XEQT and which one might be better for some people than the other. So let's get right into the video. I'm so excited. I've missed you guys. So let's define asset allocation just so that there's no confusion. So when we're talking about asset allocation, asset means these ETFs are going to be holding a mix of assets, typically stocks or equities and bonds. And allocation means that with these different ETFs, there will be a different percentage mix of how much is equities and how much is bonds. So for example, you could have one asset allocation ETFs that is 100% equities, 0% bonds. You could have 80% equities, 20% bonds, or way on the other spectrum, you could have, let's say, 70% bonds, 30% equities. And what percentage is right for you is really dependent on where you are in your life stage and what your goals are with your investment portfolio. But we'll talk about which of these ETFs might be right for different people at the end of the video. Let's get right into looking at these specific ETFs. So first, starting out with the 100% equity and 0% bond ETFs, we have VEQT, which is Vanguard's all equity ETF portfolio. And it has a management fee of 0.22%. And the goal of this ETF is long-term capital appreciation, meaning the the price of the units of the ETF that you hold goes up over time, and eventually you have a large capital gain. Now, Now there is a small distribution of about 1.6% on this ETF, so you will get some cash deposits in your account as well, but it's not the primary way that you get your returns with this ETF. Now you can see down here as far as the mix of different ETFs within VEQT, and you have a US total market, you have a Canadian market, and then you also have developed and emerging markets, and these are all equities, again, because it's a 100% equity ETF. And the returns of this ETF, you can see them listed right down here for the most recent years. I think it's another one of these great all-in-one portfolios where you can't really go wrong, and especially as a beginner, you're probably going to do a lot better just buying and holding this as opposed to trying to pick individual stocks. A mistake I see, I think I'm going to make a video on like most common mistakes, but a mistake I see people make all the time who are new to the stock market is the first thing they'll do when they want to buy any type of asset is they'll go immediately to like super volatile, I don't want to say high risk, but they'll go to really high volatility, let's say stock picking, and then they'll get burned by it and like totally be turned off by the stock market, when what you really want to be doing as a beginner is picking like the easiest, most hands-off, and I'm trying to think of the word, just like idiot-proof type of investment, and like it should be like incredibly boring. Like if your first purchase is really exciting you, you're probably taking on more risk than you should. Like these ETFs here, they're just really boring because all you do is buy and you keep buying and you keep adding, and over the long term you do really well, but month to month you're not going to see any crazy returns. And especially if you're in for the long haul, you're relying on these funds for your retirement, or you're a beginner and you just simply don't really know what you're doing, boring is actually really good. And VEQT is an example of a boring ETF. But with that said, because it's 100% equities, you still will experience those sharp downturns in the market like we just had this past 40% downturn. So you have to understand that that's going to happen, and that has to be okay and aligned with the risk that you're willing to tolerate. And the next ETF we have is XEQT, which is BlackRock Ishares Core Equity ETF Portfolio. This one is also 100% equities, 0% bonds, and it's essentially BlackRock Ishares' version of Vanguard's VEQT. The management fee is 0.18%, and the goal of this ETF is long-term capital appreciation, but you do get a little bit higher of a yield with this ETF at 3% compared to VEQT. And the returns are also super similar as well. Honestly, the difference between these two ETFs is really splitting hairs, and there are some other minor differences of weighting of different markets, but they're so insignificant it's literally not even worth mentioning. But if you are looking for 100% equity, 0% bond ETFs, then VEQT and XEQT are some of the most popular. Okay, next let's look at the two ETFs that are 80% equities and 20% bond mix, starting with VGRO, Vanguard's growth ETF. I feel like everybody knows VGRO. I feel like the name VGRO just like rolls off the tongue. Everybody's seen the meme, just buy VGRO. And honestly, it's kind of true. If there was an ETF that you were going to only put your money into one thing and one thing only, and have a diversified portfolio that's most likely going to do really well over the long term, that you never really have to check up on, it's probably VGRO. It doesn't really get much easier than this ETF. The management fee for it is 0.18. You do get a distribution yield of I think around 2%. I'll write here if I'm wrong, but I think it's around 2%. And as far as the asset allocation, it's literally the same pie of VEQT, except all those sections are shrunk a little bit to make room for 20% of bond ETFs. And of course, when you're thinking about bonds, you know that you are going to be stabilizing some of those crashes in your portfolio, but at the expense of slightly lower returns. Bonds are much more stable, but you're not going to get the same returns that equities give you. And so considering that, the returns of this ETF are still really amazing, and some of these ETFs haven't been around for that long, so you don't have super long-term history to look at, but I've popped the 3 most recent years for you guys to check out. And of course, I'll actually link all of the ETFs so you can go to the website and read about them yourself. But yeah, VGRO, I feel like, doesn't need a lot of introduction. Everybody knows VGRO, but I figure I should mention it in case you haven't heard of it, because it's a good one. All right, and the next one is XGRO, and this is BlackRock Ishares version of VGRO. The management fee is 0.18, and the distribution yield you're going to get is a little bit higher as well at about 3%. So you'll notice a trend here between Vanguard and Ishares. Vanguard tends to have a little bit higher management fee and lower distribution, whereas BlackRock has a little bit lower management fee and a little bit higher of a distribution. So, depending on what you're looking for as far as distributions, that might sway you. I mean, 1% difference between the two is not super significant, but I guess if it's something that is important to you, getting that little bit of extra cash distribution versus increase in share price, it might be worth it for you. As far as the management fee, I feel like management fee is always like a leapfrog game. Like they're always trying to, they cut their management fee and then they cut their management fee and then they cut theirs. But generally speaking, Vanguard's management fees tend to be a little bit higher, I think, because they know they can get away with it, because Vanguard is it's like Vanguard. It's like the Kleenex of tissues. They can get away with charging more because people want Kleenex. It's just that household name of investment portfolios. So I honestly feel like that's why their management fee is higher. They don't feel like they need to cut it to be competitive, because people just love Vanguard and they're willing to pay more. But as you can see with these ETFs and the underlying holdings, they're very, very similar. So I don't think you could go wrong picking either. And same as VGRO, the goal for XGRO is mainly long-term capital appreciation with a little bit of thwarting of the severe market crashes with the 20% bond mix. And you do get that little distribution as well. And again, the returns, I mean, they're great. What can you say? Very few beginners are going to receive these types of returns by picking individual stock, unless you are like the top 1% of savant new beginner investors. So again, this is why I say, if you are a beginner, or if you are really lazy and like to keep things boring, not interesting, keep things boring. If you want to keep things boring and you want low fees, I mean, the asset allocation ETFs are really nice. All right, now you might be thinking, well, you have the 100% equities, 0% bonds, and 80% equities, 20% bonds. Which one might be right for me? And in my opinion, a lot of this comes down to risk tolerance. So for example, if you had a $100,000 portfolio and you experienced a 40% market crash like we just did recently, over a period of about 1 month, your portfolio went down to 60,000. Would you at that point sell and want to move your money into something safer? In other words, maybe a portfolio that's a little bit less volatile, like a portfolio that contains some bonds. If you think that's something you would do, then you're probably better off owning a portfolio that has some bonds in it, so that you are less likely to have an emotional episode when the market goes down. If you think you are someone who would be able to still hold on and wait for the recovery after experiencing a 40% downturn, then you're probably somebody who's more likely to be successful with a 100% equity portfolio. And really, you have to remember that selling at the lows destroys compounding, and compounding is really what we are after. And the best thing to do is to do nothing and just let the compounding work. Too often we get our paws into the mix and we screw things up. So that's one thing to think about. Another thing to think about would be your age and your time horizon. Typically, the older you are, the higher bond mix you want. The younger you are and the longer your horizon, the less bond mix you have, or no bond mix. Personally, I don't own any bonds because I'm young and I have pretty severe risk tolerance. Really, at this point, nothing phases me anymore. But those are just some things to think about. So I hope you guys enjoyed this video. Let me know if you have any comments or questions down below, and I'll see you guys in the next one. Bye.